Harness the power of dividend stocks, a proven strategy for generating consistent income. Picture this. Dividend stocks are like fruit-bearing trees in your financial garden. They provide a continuous stream of income, rewarding you whether you're a short-term trader or a long-term investor. It's the power of compounding, the ability to earn income on your income. Now you may ask, how can you tap into this potential? The answer lies in understanding how to invest in dividend-paying stocks. To effectively invest in dividend stocks, you must first comprehend what they are and how they work. Dividends are portions of a company's profits shared with its shareholders. They're a way for companies to distribute a part of their earnings back to you, the investor. Imagine a pie where the whole pie represents a company's earnings. Slices of this pie, the dividends, are then served to shareholders. The size of your slice depends on how many shares you own. However, not all pies are created equal. A company's ability to pay dividends can be influenced by various factors. These may include its profitability, its debt level, and its reinvestment needs. If a company's profits are low, or it has high debts or significant reinvestment requirements, it might choose to retain more of its earnings, resulting in smaller or no dividends. Armed with this knowledge, you can now start your journey into investing in dividend-paying stocks. Investing in dividend stocks is a process that requires careful planning and consideration. Let's delve into a step-by-step guide to help you navigate this journey. Step 1. Research. Dive deep into the world of companies offering dividends. Look at their history, their business models, and the sectors they operate in. This will give you a solid understanding of where your potential investment stands in the grand scheme of things. Step 2. Analyze. Once you've gathered your short list of dividend-paying companies, it's time to assess their financial health. Examine their balance sheets, income statements, and cash flow statements. Look for consistent profitability, a solid return on equity, and a manageable level of debt. Companies with these attributes are more likely to pay steady, reliable dividends. Step 3. Evaluate. Now turn your attention to the company's dividend history. Has it consistently paid dividends? Has the dividend amount increased over time? Companies with a strong track record of paying and increasing dividends are more likely to continue doing so in the future. Step 4. Diversify. It's not wise to put all your eggs in one basket. Diversification is a key strategy in managing risk. Spread your investments across different sectors and companies. This way, if one stock performs poorly, it's less likely to significantly impact your overall portfolio. Step 5. Reinvest. Consider the benefits and drawbacks of reinvesting dividends. On one hand, reinvesting can compound your returns over time. On the other, it may make more sense to take the dividends as cash if you need the income now. Evaluate your financial goals to make the best decision for your situation. Remember, investing in dividend stocks is not a one-size-fits-all strategy. It requires diligence, patience, and a keen eye for detail. It's not just about choosing stocks that pay dividends, but choosing the right ones that align with your financial objectives. By following these steps, you can maximize your income from dividend stocks and minimize your risk. Investing in dividend stocks can be highly rewarding, but it's crucial to remember certain key points. Let's take a moment to summarize those key points. Firstly, always remember the importance of research. Just like any other investment, knowledge is power. Understand the company, its financial health, and its history of dividend payouts. Don't just chase high yields. Look for companies with a consistent record of stable and growing dividends. Secondly, diversification is your best defense against risk. Don't put all your eggs in one basket. Spread your investments across different sectors and companies. This way, even if one stock performs poorly, others may do well, balancing out your overall returns. The third point is patience. Dividend investing is not a get-rich-quick scheme. It's about building wealth over time. It takes patience to see your investments grow and compound. So stay invested and let your money work for you. This leads us to the fourth point, long-term thinking. Dividend investing is a marathon, not a sprint. It's about consistent income over many years. So have a long-term investment horizon and resist the temptation to sell at the first sign of trouble. Lastly, be aware of the potential risks and manage them effectively. No investment is without risk, including dividend stocks. A company may cut its dividend or worse, go out of business. So always keep an eye on your investments and be ready to make adjustments when necessary. With these key points in mind, you're well on your way to harnessing the power of dividend stocks and building a steady stream of income.